Howdy, everybody. Welcome to Liberty Call. It is Wednesday, July 9th, 2025. Hope you're having a fantastical day out there in the interwebs. As you can see over my shoulder, I've been doing some work in the hall bathroom. It is almost done. Just have to put some trim down, install the vanity and new sink. Awesome work. So, little project that should have only taken a couple of days has turned into like a week because I had to cut out drywall. Anytime you remove stuff in an old house, there's always going to be extra projects that come on onto your plate. So anyways, all right. Well, market shrugged off fresh tariff headlines as Nvidia vaulted past a $4 trillion valuation and the Fed signaled flexibility. The S&P 500 gained 0.6, the Nasdaq climbed 0.9, and small caps joined the rally as investors balanced trade noise with tech euphoria. Fed minutes revealed quantitative tightening may run into 2026, but rate cuts are still on the table. Meanwhile, Merck's acquisition of Verona added some M&A fuel to the fire. So before we break all the news down, my boys are getting itchy back here. They want to go play. They've been trapped in this office most of the day. So we're going to bust through this as quickly as we can. But before we do, I need some thumbs up from you or help from you. I need some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. Woo! And I'm all sweaty too. And I need a haircut. Look, I look like a hippie with all this long hair. All right, let's get to the markets. Dow Jones was up 0.49%, 217 points, closed at 44,458. S&P 500 up 0.61%, closed 37 points, closed at 62,63. Nasdaq up 0.95%, 192 points, closed at 2611. The VIX was down 5.23% today. It's at 1593, Canada 0.26, Brazil down 1.31%, and Mexico down 0.87. In Europe, Germany up 1.42%, the UK up 0.15%, France up 1.44%, Netherlands up 0.22%, Spain up 1.24%, Italy up 1.59%, Switzerland up 0.16%, and Portugal up 0.75%. Russian exchanges both in the red and both closed down 2.17%. And the overnight markets, the Nikkei in Japan was up a third, Australia down 0.61, New Zealand down 0.81. In China, the Shanghai was down 0.13, Shenzhen Component down 0.06, China A50 up 0.18. Hey, quiet. And let's see here. My little watchdog Nolan back here is being grouchy. China A50 was up. DJ Shanghai down 0.28. Hang Seng down 1.06. And the Taiwan weighted was down 0.3 when it closed on the 8th. All right. Okay, well, let's get to the market recap. I'm reading the news to people, so be quiet. All right. Market recap. Nasdaq notches closing record as Nvidia hits $4 trillion. All right, the Nasdaq closed at record highs on Wednesday, propelled by a surge in tech stocks and strong gains from Nvidia. Even as President Donald Trump escalated his tariff agenda, Nvidia rose 2%, pushing its market capitalization above $4 trillion for the first time, reinforcing its dominance in the AI chip market. Analysts from Wedbush called it a historic milestone, signaling the next stage of the AI revolution. Other tech stocks, including Meta Platforms, also climbed, helping the broader tech sector weather Trump's trade turbulence. Despite fresh tariff threats, it's this time targeting copper with a potential 50% duty. The tech-heavy Nasdaq continued to show resilience. Meanwhile, the Federal Reserve released minutes from its June meeting, revealing a still divided central bank. While most policymakers still anticipate rate cuts this year, a few support cuts as early as July, and others see no need for easing. Yeah, I fall into that camp. President Trump has criticized Fed Chair Jerome Powell, and reports suggest White House advisor Kevin Hassett is now a leading candidate to replace him. Trump confirmed the new August 1st tariff deadline is final, targeting major economies and sectors such as copper, semiconductors, and pharmaceuticals. Treasury Secretary Scott Bessent claimed these tariffs have already generated $100 billion in revenue this year and could hit $300 billion by year end. Well, that'll make a huge dent in the $36 trillion federal debt, Mr. Bessent. Despite the upbeat tech performance, Goldman Sachs struck a cautious tone, warning of limited upside for equities in the short term due to evaluated valuations and a weakening macro backdrop. While they maintain a bullish 12-month outlook, Goldman emphasizes the increased risk of a near-term market pullback. Overall, investors appear to be balancing optimism around tech-led growth and AI innovation against rising geopolitical risks and uncertain monetary policy. All right. Well, that was very, very interesting. Why are you being so grouchy right now? Go bite on Jake. All righty. Let's get to our next article here. Wholesale inventories meet forecast with a 0.3% drop, shows bearish outlook for the U.S. dollar. All right. Let me get my notes up here, and I might have to smack a dog if he won't be quiet. All right. The latest reports on U.S. wholesale inventory shows a 0.3% decline, matching economists' forecast and marking a notable reversal from the previous 0.2% increase. This drop suggests potential weakness in economic activity and carries a bearish implication for the U.S. dollar. Wholesale inventories track changes in total value of goods held by wholesalers. A decline often signals that businesses are reducing stockpiles due to weaker demand or slower production. When actual figures meet or fall below expectations, it can indicate reduced confidence in economic growth, pressuring the U.S. dollar downward. The latest figure reflects a shift from the prior period's modest inventory buildup, reinforcing concerns about a potential cooling in the supply chain or consumer demand. While a drop in inventories can occasionally suggest improved efficiency, sustained declines are generally associated with slower economic momentum. That's what I've been really paying a lot of attention to is the consumer spending. When it really starts to fall off, I expect jobs will be next, and then we should probably expect some sort of a downward market at that point. Let's see. However, it's important to view this data in the broader economic context. Wholesale inventories are just one of many indicators affecting the U.S. dollar. Consumer spending trends, labor market strength, inflation, and geopolitical developments also play a critical role in shaping these currency movements. In summary, the 0.3% fall in wholesale inventories aligns with with forecasts and may weigh on the dollar, but the ultimate impact depends on broader economic trajectory and upcoming data. All right, good stuff. And we got one last article here. It's the Fed meeting minutes. It's going to take a little longer to go through, but this is from the June meeting on the 17th and 18th, where they held rates steady. So we'll jam through this, and I'll get these monsters outside and run them ragged for a bit. All right. At the June FOMC meeting, the Federal Reserve maintained the federal funds rate at 4.25 to 4.5 amid persistent inflation and solid economic growth. Participants acknowledged that while inflation has eased from its peak, if it remained above the 2% target, labor market conditions were stable and unemployment held at 4.2%, reflecting the resilient economy. However, concern persisted about uncertainty from trade, fiscal policy, and global geopolitical developments. The committee discussed how risk and uncertainty influence policy decisions and communications, exploring possible enhancements to tools like the summary of economic projections and use of scenario analysis. There was a consensus to continue refining communication strategies later in the year. Markets showed moderate optimism since the last meeting, with yields and equities rising, credit spreads narrowing, and auction performance improving. The dollar weakened slightly due to downgraded U.S. growth expectations. Inflation compensation declined in the near term, but remained stable long term. The Fed's balance sheet runoff continued, with the SOMA portfolio declining by nearly $2.25 trillion since June of 22. Reserve levels were still abundant at nearly $3.5 trillion, but the Treasury General Account was expected to be rebuilt post-debt ceiling resolution, tightening liquidity. Economic data suggests real GDP was expanding in Q2, following a slight decline in Q1. Inflation as of May was estimated at 2.3% headline and 2.6% core PCE. Labor participation edged down slightly, but remained steady overall. Business investments showed signs of moderating, though private credit and capital markets remained accessible. On the international front, trade flows remain volatile, with surges and drops likely linked to tariff timing. Foreign economic activity softened in Q2, while inflation abroad was mostly stable. Several foreign central banks eased policy due to growth concerns. The Fed staff raised GDP projections and lowered inflation expectations, seeing tariffs as inflationary in the short term, but manageable long term. They viewed recession risks as lower than in May, but maintained a cautious stance. Participants echoed this, citing reduced but still present downside risks to growth and upside risk to inflation. On inflation, participants debated the impacts of recent tariff hikes. Some expected limited pass-through prices. Others warned of potential stickiness, especially if firms use the hikes to mask broader price increases. Many stressed the importance of anchoring long-term inflation expectations to avoid sustained inflationary pressure. The labor market was considered healthy, but potentially at risk from persistent policy uncertainty. Some indicators suggest hiring had slowed and businesses were pausing new investments. Wage growth had moderated at 3.9% annually. In conclusion, while participants saw some room for rate cuts later in the year, they emphasized a cautious, data-driven approach. Some saw room for a cut as early as July. Others favored no action in 2025 without further inflation progress. The committee agreed to continue reducing security holdings and to monitor developments closely. All members voted to maintain the current rate and reaffirm the Fed's commitment to maximum employment and 2% inflation. The next meeting is scheduled for the end of this month at July 29th and 30th. All right, so good stuff there. So basically more of the same is what they're saying, and that's kind of where we're at for now. So all right, well, that is everything that I have to cover for today. If anyone needs anything from me, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there, so give me a buzz. I'd be glad to help. Hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.